the little book that beats the market. So there's three things we're going to talk about: applying the magic formula, find the right companies, and be patient. Joel was born in 1957. He has a degree in economics from University of Rochester and an MBA from Wharton School. He founded Gotham Capital in 1985 and achieved an impressive annualized net return of 34% from 1985 to 1994, which is a massive return during that time. And to just go straight to the point, he talks about what he calls the magic formula. And the magic formula is pretty simple. It's earnings yield, which is a measure of whether something's cheap or expensive, and return on capital, which is a measure of whether something is profitable or unprofitable, a company. Let's look at what he starts off with. So he's talking about starting to invest. Investing is challenging. Your investment strategy should be understandable to you, very important. And this is the key to sticking with a long-term strategy. Stock market has many opportunities, could be turnaround, small cap, that type of thing. And you can buy businesses on the stock market at a discount. However, starting can be difficult. So investing requires gauging uncertainty, and valuing a business is challenging. One of the critical things is that you want to evaluate stocks effectively. To do so, you want to incorporate two critical metrics in your analysis. And here comes the magic formula. The first is earnings yield, and this measures annual earnings per dollar invested. You need the previous earnings per share and the current stock price. All right, we're going to talk about finding the right companies. Actually, this is the heart of the book, and I'm really excited to share the work I've done to explain this in more detail. Create two separate lists. Rank the first list by earnings yield from highest to lowest. And let's say the highest earnings yield is a 1, right? And the lowest would be 3,500. And then you order the list by return on invested capital. You combine both of these rankings into one list. So say a company's ranks first for earnings yield and 153 for return on capital. You add both numbers to get a combined rank of 154. So by doing this, you get a composite scoring system. And this list will reveal the best performers based on both metrics. It's what I like to call combined scoring, and where you're trying to measure which company is best on both measures combined. And this is a core part of my FEMR investing, and a lot of it came originally from reading this book. At the end of the year, you sell the winners and losers, and you repeat the process. In other words, you convert the portfolio to cash is kind of what you do. Sometimes it's very hard to follow exactly what they're doing. And so I've spent considerable time working on this to help you understand it. Cash. Now, I will stop for a moment just to talk about cash, because truthfully, when you do this type of calculation, you really don't want to take out all cash because you need cash. Really, that calculation should be excess cash. What I decided to do was take the aggregate balance sheet of all companies in the world going back on average over the last 20 years. That gives me like a composite balance sheet income statement that we can calculate kind of an average. So let's start by understanding the data. So that is the traditional net working capital calculation I just showed you. But I'm going to show you an alternative net working capital calculation that I call free cash flow net working capital. It's the one I use for valuing companies, but it's also what Joel Greenblatt is using. So let's look at this. And we know that if the price rises, then the PE ratio is going to rise. So it's an inversion of a typical PE. In this case, this is price, and this is EPS. That's usually what it is for PE. But here we have price is equal to what? EV, or enterprise value. And earnings is equal to EBIT, not EPS. So some slight modifications.